Have you ever looked at a company's, profit and loss statement and thought, okay, income minus expenses equals profit? Seems pretty simple.
Yeah.
Well, what if I told you that even those basic terms, they hide this whole labyrinth of fascinating complexities, especially, when you bring the tax man into the picture?
Oh, absolutely true. The world of corporate finance and, yeah, particularly taxation,
Yeah.
it's way more nuanced, more strategically important than it seems at first glance.
And that's where we come in. Welcome, everyone, to the deep dive.
Glad to be here.
This is the show where we take complex sources, could be articles, research, maybe even our own notes, and we just pull out the most important bits of knowledge, the surprising facts, maybe a little humor to keep you hooked.
Yeah, keep it interesting.
This deep dive is custom tailored for you, our listener, because, well, we think understanding the financial world shouldn't feel like cracking open a textbook.
Couldn't agree more. And today, we are doing a deep dive into the fascinating world of C corporations, specifically how they're taxed. And this is really crucial stuff for anyone looking to truly understand business finance. Maybe you're prepping for a big meeting, maybe exploring a new field, or maybe you're just super curious about how the big players actually work under the hood.
Exactly. So our mission today is to try and simplify these intricate rules. We're talking C corporation, taxable income, deductions, special considerations, even how they handle losses when things go wrong.
Yep, the whole shebang.
By the end of this deep dive, our goal is that you walk away feeling genuinely well-informed, feeling ready to tackle your next financial conversation with, hopefully, a lot more confidence.
Yep.
Okay, let's get into it.
All right, let's start right at the foundation. Gross income. For C corporations, the concept is, well, surprisingly similar to individuals, actually. Generally, income is recognized when it's received.
Okay, that phrase, when received, that feels really important, especially for like cash received in advance.
Exactly. So even if a C corp hasn't technically earned the income yet, according to, GAAP generally accepted accounting principles, the sort of standard rule book for financial reporting.
Right, the book stuff.
Yeah, the book stuff. Even then, it's often taxed right when that cash hits the bank account.
Wow. Okay, so examples?
Think about things like interest income received early, rental income paid up front. That includes non-refundable deposits too, and even royalty income that comes in way before it's technically earned under GAAP.
So companies might actually pay tax on money they haven't even put down as revenue on their main financial statements yet.
That's it, exactly. It's a key difference between tax accounting and financial accounting.
Okay. And on the flip side, are there things that show up as income on the financial statements but aren't taxed?
Yes, absolutely. And this is where you start seeing some, well, interesting tax planning opportunities. For instance, interest income earned from municipal or state obligations. Muni bonds.
Ah, the classic tax-exempt bonds.
Right. That income is typically tax exempt for corporations holding them, just like for individuals.
That makes sense. What else might surprise people by being excluded from taxable income?
Another one that often raises eyebrows involves certain proceeds from life insurance policies, specifically on key persons, where the corporation itself is the beneficiary.
Okay, key person insurance. How does that work tax-wise?
Well, the rules have some specific requirements, and they've changed a bit over time. But generally, the part of the proceeds that equals the premiums the company already paid, plus other non-deductible amounts, that part can be tax-free.
Okay, just the cost basis, basically.
Sort of.
Yeah.
But the balance, the gain, is typically taxable, especially for policies issued after August 17, 2006, unless some very specific conditions are met.
Yeah.
So it's definitely not a blanket all life insurance payouts are tax-free situation for corporations.
That's a really crucial detail because, yeah, I think a lot of people just assume life insurance equals tax-free.
Not always for corporations receiving the benefit.
And speaking of differences from individuals, what about capital gains? Because, for us regular folks, those often get a special lower tax rate. Is that true for C Corp?
This is a huge difference, actually, for C corporations. Corporate capital gains are taxed at the exact same rate as their ordinary corporate income.
Wow. No special treatment.
Nope. No special lower long-term capital gains rates apply here, unlike for individual taxpayers. That flat 21% rate applies to both ordinary income and capital gains.
So what does that mean strategically?
Well, it removes one big incentive for corporations to hold on to assets for, say, over a year just to get a lower tax rate. It kind of simplifies their investment decisions from that one tax angle anyway.
That is a big one right off the bat. Okay, now let's talk about how corporations actually keep their books. We hear about accrual basis and cash basis accounting. For tax purposes, who uses what?
Right, the two main methods. So most individuals and certain smaller businesses specifically, those with average annual gross receipts not exceeding $29 million for the prior 3 years, they can generally use the simpler cash basis for tax.
Cash basis meaning income when cash received, expenses when cash paid out. Simple enough.
Basically, yeah. But C corporations, by and large, they must use the accrual basis.
Must. So for most C Corp, it's not just a preference, it's a requirement. They have to recognize income when it's earned and expenses when they're incurred, regardless of when the cash actually moved.
That's generally the rule, yes.
Yeah.
It's a requirement for most C Corp.
Are there other types of entities or situations that also require the accrual basis?
Yes, there are. The accrual basis is also required for accounting for purchases and sales of inventory, especially if the business has average annual gross receipts over that $29 million mark.
Okay, inventory makes sense.
Also mandated for entities classified as tax shelters, certain large farming corporations, again, exceeding that $29 million threshold. And interestingly, partnerships that have a C corporation as a partner, if their gross receipts are over $29 million.
So that $29 million average gross receipts number is kind of a key threshold for several of these rules.
It is. It pops up quite a bit as a sort of small business exception threshold.
All right, so that sets the stage for how income is recognized and how the books are kept. Now, once we know what counts as income, the next massive piece of the puzzle for any corporation, and definitely for the IRS, is figuring out what counts as a legitimate expense.
Ah, yes. Deductions.
This brings us to the huge world of deductions, all governed by that really crucial phrase, ordinary and necessary. What does that actually mean in practice?
It's a great question. It basically means expenses that are common or accepted in that particular business or industry. And importantly, they have to be helpful or appropriate for producing the current year's income.
Okay, common and helpful. Examples.
Think of, reasonable salaries paid to employees, office rents, supplies for the office, even travel expenses, but only if they're purely for business purposes. Those are all classic examples of deductible, ordinary, and necessary expenses.
Okay, let's dig into one of those. Executive compensation. Because, wow, that can be a truly enormous number on a corporate income statement. Is there a limit to how much a company can deduct for its top executives?
Yes, there is, and it's a significant one for publicly held corporations. There's a $1 million deduction limit per year for compensation paid to covered employees.
Covered employees, who's that?
Typically, it includes the CEO, the CFO, and then the three other most highly compensated officers. And what's really interesting here is that when someone becomes a covered employee, they stay one for all future years.
Wait, even if they step down from being CEO or CFO?
Yep. Even if their role changes or they're no longer one of the top three highest paid, besides the CEO, CFO, their compensation could still be subject to that $1 million deductibility cap going forward.
Wow, that's sticky. Now, what if the IRS looks at a shareholder's salary, maybe in a smaller, closely held corporation, and thinks it's, let's say, a bit too generous?
The unreasonable compensation issue. The IRS definitely has the power to reclassify what they deem unreasonable shareholder salaries as essentially non-deductible dividends.
That makes a big difference, right? Salary versus dividend.
Huge difference with implications for both sides. From the corporation's perspective, a salary is normally a deductible business expense, although it's subject to payroll taxes.
Right.
A dividend, however, is paid out of after-tax profit, so it's not deductible at all for the corporation.
Okay. And for the shareholder receiving it?
For the shareholder, a salary is ordinary income, taxed at their regular rates, plus it's subject to Social Security and Medicare taxes. A dividend, on the other hand, is usually taxed at lower preferential qualified dividend rates. So that reclassification by the IRS, we can have a really serious tax impact, potentially increasing taxes for the corporation and maybe changing the tax picture for the individual too.
That is a powerful aha moment, understanding that distinction. Okay, moving on to bonuses. Lots of companies pay year-end bonuses. When are those deductible for these accrual basis taxpayers?
Good question. For accrual basis taxpayers, bonuses are deductible in the tax year when the company's liability for them is established with reasonable accuracy. But here's the key timing thing. They must actually be paid within 2.5 months of the taxpayer's year end to qualify for that deduction in the earlier year.
2.5 months. Okay, like March 15th for a calendar year company.
Exactly. Meet that deadline and you can deduct it for the prior year when the liability was set.
And what if a company extends credit, sells something on account, and then the customer just doesn't pay? How does the IRS treat that uncollectible money, those bad debts?
Right, bad debts. Accrual method taxpayers are required to use what's called the specific charge-off method for tax purposes.
Specific charge-off.
Yeah, it means they can only write off bad debts as they specifically become worthless or partially worthless. Now, for financial accounting, GAAP, companies often use an allowance method, estimating bad debts, but that's not allowed for the tax deduction itself.
Okay, so no estimating for tax deductions, only when a specific debt goes bad. What about cash basis taxpayers? If they never got the cash, can they deduct a bad debt?
This is a crucial distinction. Generally, for cash basis taxpayers, bad debts are not deductible. Why? Because the income was never included in their gross income in the first place.
You can't deduct something you never counted as income.
Exactly. The rare exception might be, say, an uncollectible check that was already deposited and incorrectly recorded as income. But generally, if you're cash basis and didn't get paid, you just didn't get paid. No income recognized, so no loss to deduct.
That makes perfect sense when you put it that way. Okay, how about business interest expense? Companies borrow money all the time. Is all the interest they pay deductible?
Most interest incurred for business purposes is deductible, but, and this is a big but, there are important limitations, especially for larger businesses.
Limitations, like what?
The deduction is generally capped. It's capped at the sum of 1, the company's business interest income, 2, 30% of what's called adjusted taxable income, or ATI, and 3, any floor plan financing interest expense, which is common for dealerships.
Okay, hold on. Adjusted taxable income, ATI. What's that?
ATI is basically your taxable business income, but you calculate it before you account for any interest income or expense, and also before depreciation or amortization deductions. It's a specific measure used just for this calculation.
That sounds pretty technical. Does this 30% of ATI limitation apply to every single business?
No, thankfully. It does not apply if the taxpayer's average annual gross receipts are $29 million or less for the prior 3 years.
There's that $29 million number again.
See? It's important. So smaller businesses generally don't have to worry about this specific interest limitation. But for larger businesses, this can have a very real impact. Well, think about heavily leveraged corporations, companies with a lot of debt. Even if they're profitable, they might not be able to fully deduct all their borrowing costs because of this cap. That effectively increases their taxable income, maybe forces them to rethink their debt strategies.
And if they can't deduct all the interest in 1 year, is it lost forever?
No, disallowed interest isn't lost. It can be carried forward indefinitely to potentially be used in future years when they have more capacity under the limitation.
Okay, good to know. Any other wrinkles with interest deductions?
Just a couple quick ones. Prepaid interest generally has to be allocated to the period it actually relates to. You can't just deduct it all up front. And logically, interest you pay on debt that you use to purchase tax-free investments like those municipal bonds we talked about, that interest is not deductible.
Right, can't get a deduction for interest that generates tax-free income. Makes sense. Okay, beyond the regular day-to-day operating expenses, corporations often give back to the community through charitable contributions. How generous is the IRS when it comes to deducting those?
Corporations do get a deduction for charitable contributions, but it's capped. The maximum deduction is 10% of their taxable income.
10% of taxable income. Is that calculated before or after the contribution itself?
That's a key point. It's calculated before considering the charitable contribution deduction itself. Also, before the dividends received deduction, which we'll get to, and before any capital loss carryback.
Okay, so 10% of a specific adjusted taxable income figure. What if they donate more than that 10% limit?
Any contributions that exceed the 10% limit aren't lost. They can be carried forward for 5 years. And similar to bonuses, for accrual basis corporations, any accrued contributions must be paid within 3.5 months of the corporation's year-end to be deductible for that year.
3.5 months this time. Got it. What about when bad things happen, like business losses or casualty losses? Say a fire damages a factory or a storm hits a warehouse. How are those losses calculated for tax?
Generally, any loss from a casualty, like a fire or storm, that isn't compensated for by insurance is deductible. The calculation, though, differs depending on whether the property is partially destroyed or, well, completely wiped out.
Okay, how does it work for partially destroyed property?
For partial destruction, the deductible loss is the lesser of 2 amounts. Either the decline in the property's fair market value due to the casualty, or the property's adjusted basis.
Adjusted basis. Remind us what that is.
Sure. Think of adjusted basis as the original cost of the asset, plus any capital improvements, minus any depreciation you've already taken. It's the asset's book value for tax purposes, essentially.
Got it. So for partial loss, it's the lower of the value drop or the tax book value. What about for fully destroyed property?
If the property is totally destroyed, it's simpler. The loss is just the adjusted basis of the property, minus any insurance proceeds received.
Okay, let's nail this down with an example. Let's say Bad Luck Inc. has a warehouse damaged by a nasty storm. Its fair market value before the storm was $850,000, and after the storm, it's only worth $400,000. The adjusted basis of the warehouse was $600,000, and they got $300,000 in insurance money. If it's just partial destruction, what's their deductible loss?
Okay, let's break it down. The decline in value is 850Ks minus 400K, which is $450,000. The adjusted basis is $600,000. For partial destruction, we take the lesser of the decline in value, 450K, or the adjusted basis, $600.
So the lesser amount is $450,000.
Right. That's the loss before insurance. Then we subtract the $300,000 insurance reimbursement. So $450,000 minus $300,000 means Bad Luck Inc. Deductible casualty loss is $150,000.
Okay, $150K for partial loss. Now, same facts, but what if that warehouse was totally destroyed by the storm?
If it's a total loss, the rule changes. We don't worry about the decline in value. The deductible loss is simply the adjusted basis minus the insurance proceeds.
So that's the $600,000 adjusted basis minus the $300,000 insurance.
Exactly. For a total destruction, the deductible loss would be $300,000. It highlights how the calculation method really depends on the extent of the damage.
Got it. Super clear now. Okay, let's shift to new businesses. There are often significant costs before they even open their doors or make their first sale. Organizational costs, startup costs. How does the IRS treat those?
Yes, getting started. A corporation can elect to deduct right away up to $5,000 for organizational costs and another $5,000 for startup costs in the year they begin business.
Okay, $5,000 for each. Sounds good. Is there a catch?
There's a bit of a phase-out. Each of those $5,000 deductible amounts is reduced, dollar for dollar, by the amount that the respective costs exceed $50,000.
So if you spend, say, $52,000 on organizational costs, your immediate deduction drops from $5,000 down to $3,000.
Precisely. And any remaining costs, meaning the costs above that initial $5,000 deduction or the reduced amount, are then amortized.
Amortized meaning spread out.
Yeah, spread out and deducted over 180 months. That's 15 years. And that amortization starts when the active trader business actually begins.
Okay, so it's not just a flat $5K deduction. There's this clever phase out that limits the immediate benefit if you have really large initial expenses. What kind of costs actually qualify as organizational or startup costs for this?
Good question. Included costs are typically things like legal fees for drafting the corporate charter, the bylaws, initial meeting minutes, also accounting fees related to actually setting up the corporate entity, and state and corporation fees.
What's not included?
Crucially, costs directly related to issuing and selling stock commissions to brokers, underwriter fees, those are excluded. Also, costs of transferring assets into the new corporation generally don't qualify for this deduction or amortization. They usually adjust the basis of the assets or stock.
And I remember you mentioning a GAAP versus tax difference here earlier.
Right.
How are these treated differently on the financial books versus the tax return?
Absolutely. It's a big difference. For GAAP, for financial reporting, these organizational and startup costs are generally just expensed immediately, written off in the year incurred. But for tax, as we just discussed, it's that specific rule. The $5,000 immediate expense, subject to the $50,000 phase-out, and then the 180-month amortization for the rest. It's a very clear example of where book income and taxable income will definitely diverge right from the start.
Let's use another example to lock this in. Christie Co., formed on June 30th, began doing business on July 1st, and has a December 31st year-end. They paid $15,000 in legal fees for the charter, $5,000 in accounting fees to set up, $3,000 in state fees. They also spent $10,000 on costs related to selling shares of stock. What's their total deduction for these items in year one?
Okay, first step. Identify the eligible organizational expenses. That's the $15K legal plus $5K accounting plus $3K state fees. That totals $23,000.
And the $10,000 for selling stock?
That's excluded, not deductible or amortizable as an organizational expense. So we focus on the $23,000. Since $23,000 is less than the $50,000 threshold, there's no phase out of the initial deduction.
So they get the full $5,000 up front.
Yes, they can deduct the initial $5,000 right away in year one. The remaining amount is $23,000 minus that $5,000,
Hmm.
which leaves $18,000.
And that $18,000 gets amortized over 180 months.
Correct. $18,000 divided by 180 months works out to $100 per month. Now, they began business on July 1st, and their year ends December 31st. So that's 6 months of business operations in year one.
July, August, September, October, November, December. Yep, 6 months.
So they get 6 months of amortization in year one. 6 times $100 equals $600.
Okay, so the total deduction is the upfront $5,000 plus the $600 amortization.
Exactly. Their total deduction for organizational costs in year one is $5,000 plus $600 for a total of $5,600.
That example makes the calculation really clear. Okay, what about other long-term asset deductions like amortization, depreciation, and depletion for C corporations? Are the rules generally the same as for other businesses?
Generally, yes. C corporations follow the same basic rules for depreciation, like MEC IRS for tangible assets, and depletion for natural resources as other business forms. For intangible assets acquired things like goodwill, covenants not to compete, franchises, trademarks, trade names, those are typically amortized using the straight-line method over a 15-year period for tax purposes.
15-year straight line for those intangibles. And you mentioned another gap versus tax difference for purchased goodwill.
Yes, this is another important one. For tax purposes, purchased goodwill is amortized over that 15-year period. But for GAAP, for financial reporting, purchased goodwill is not amortized at all.
Really? What happens to it on the books then?
Instead of amortizing it, companies have to test it for impairment each year. Basically, they check if its value has dropped significantly. If it has, they write it down. If not, it just sits there on the balance sheet at its original cost.
So tax systematically reduces the value over 15 years, while the financial books only reduce it if there's a proven drop in value. Interesting difference.
Very different approaches. Leads to another common book tax difference.
Okay, another common business expense. Life insurance premiums. Are those always deductible? We touched on proceeds earlier, but what about paying the premiums?
Good distinction. It depends on who the beneficiary is. If the corporation is the beneficiary of the policy, like that key person policy we discussed, designed to protect the business itself, then the premiums paid by the corporation are not deductible.
Okay, premiums not deductible if the company benefits.
But if the insured employee names their own beneficiary, maybe their family, and the insurance is basically provided as a fringe benefit to that employee.
Like group term life insurance.
Could be, or other forms. In that case, where it's a benefit for the employee, then the premiums paid by the corporation are generally deductible as compensation expense.
Got it. Beneficiary makes all the difference for deductibility. Okay, how about some quick hits on other common business deductions, like, say, business gifts? Are those deductible?
Business gifts are deductible, but only up to $25 per recipient per year.
$25, not a huge amount these days. What about business meals?
Business meals are generally 50% deductible. This applies to meals while traveling for business, certain minor meals provided at the workplace, de minimis fringes, or meals provided for the convenience of the employer on premises. So you track the full cost, but only deduct half.
Okay, 50% for meals. What about business entertainment? Taking clients to a game or a show?
That changed significantly a few years ago. Business entertainment expenses are now specifically not deductible at all. Zero deduction.
Wow, okay. That's a big change from the old days.
Huge change. No more deducting those golf outings or concert tickets.
And it probably goes without saying, but things like penalties for breaking the law or costs of illegal activities, those are never deductible, right?
Absolutely correct.
Huh.
Penalties, fines levied by governments, bribes, kickbacks, none of those are deductible. Public policy prevents it. Also an important recent addition. Any payments, including related legal fees related to sexual harassment or sexual abuse, are specifically not deductible if those payments are subject to a non-disclosure agreement, an NDA.
That's a very specific and noteworthy non-deductible item.
It is. Reflects a specific policy choice.
How about taxes themselves? Can corporations deduct the taxes they pay, like state income tax or federal income tax?
Good question. State and local taxes, income taxes, property taxes, etc., incurred for business are generally deductible. Federal payroll taxes, the employer's share, are also deductible.
But what about the big one, federal income taxes?
Federal income taxes themselves are not deductible when calculating federal taxable income. That would be circular.
Right, that makes sense. What about foreign income taxes?
Foreign income taxes paid might be eligible for a foreign tax credit, which we'll talk more about later. Usually you choose between taking the credit or a deduction. Most choose the credit because it's more valuable. But if you take the credit, you generally can't also deduct those taxes.
Okay, credit usually beats deduction. And things like lobbying or political contributions?
Generally not deductible. There's some very narrow exceptions, but for the most part, costs to influence legislation or participate in political campaigns are not deductible business expenses.
Okay. And finally, let's revisit that crucial difference regarding capital losses for corporations versus individuals. You mentioned it briefly.
Yes, it's worth hammering home. That $3,000 deduction for net capital losses that individual taxpayers can take against their ordinary income each year, that is absolutely not allowed for C corporations.
So if a C Corp has more capital losses than capital gains in a year, what happens?
A C corporation can only use capital losses to offset capital gains, period. If they have excess capital losses in a year, losses exceed gains. They cannot use that excess to reduce their ordinary business income.
What happens to the excess loss then?
It's not completely lost, thankfully. It can be carried back 3 years and forward 5 years. But even in those carryover years, it can only be used to offset capital gains. It can never offset ordinary income.
That's a really significant difference from how individuals are treated and can really impact a company's tax planning, especially if they have volatile investment portfolios.
Absolutely. Managing capital gains and losses becomes a distinct strategic exercise for C corporations.
Okay, last topic in this building block section. Inventory valuation methods. How do companies figure out the cost of the goods they sell for tax purposes?
Generally, the tax methods used for inventory have to align with the company's financial accounting methods, as long as those methods clearly reflect income and are consistently applied year after year.
And we already established that the accrual basis is usually required for inventory if sales are over $29 million.
Correct, unless they meet that small taxpayer exception. Now, when it comes to valuing what's actually in stock, common methods include valuing items at cost or using the lower of cost or market LCM method. And for figuring out which costs attach to the item sold, common identification methods are FIFO or LIFO.
Can you give us a quick refresher on FIFO and LIFO?
Sure, think about a shelf of identical products bought at different times for different prices. FIFO stands for first in, first out. It assumes you sell the oldest inventory items first, so the cost of goods sold reflects those older costs.
Okay, oldest cost out first.
LIFO is the opposite. Last in, first out. It assumes you sell the newest inventory items first, so the cost of goods sold reflects the most recent costs.
Newest costs out first. Why does the choice matter so much?
It can significantly impact reported profit and taxable income, especially when prices are changing. For example, in a period of rising prices, LIFO generally results in a higher cost of goods sold, using the latest higher costs, which means lower reported profit and potentially lower taxes compared to FIFO.
Ah, so it has real tax consequences. Is there anything special about choosing LIFO?
Yes, LIFO requires a specific election to be made in the first year it's used, and there's a conformity rule. If you use LIFO for tax purposes, you generally must also use LIFO for your financial statements reported to shareholders and creditors. That consistency rule can sometimes be complex to manage.
Okay, LIFO conformity, good to know. And there's something called the Uniform Capitalization Rules, often called UNICAP or Section 263A. What's the gist of those? They sound intimidating.
They can be complex, yes. The basic idea behind UNICAP is that for tax purposes, the IRS requires businesses to capitalize more costs into the value of their inventory than might be required under GAAP.
Capitalize meaning add to the cost of the inventory rather than expensing immediately.
Exactly. Certain costs that a company might normally just deduct as period expenses, things like indirect labor, factory overhead, storage costs, even certain administrative costs related to production or acquisition under UNICAP, these have to be allocated and added to the cost basis of the inventory produced or acquired for resale.
So you don't get to deduct those costs right away.
Right. You only need to deduct them later when that inventory item is actually sold as part of the cost of goods sold. The effect is often to accelerate taxable income because you're delaying the deduction of those overhead-type costs.
Does UNICAP apply to everyone?
No, thankfully. There's an important exception. Businesses that meet that same average annual gross receipts test, $29 million or less for the prior 3 years, are generally exempt from these complex UNICAP rules. This primarily targets larger manufacturers and resellers.
Another win for smaller businesses. Okay, one last inventory point. What if goods become unsaleable or unusable, like they're damaged or obsolete?
If inventory isn't saleable at normal prices, it can be valued down for tax purposes. Specifically, it should be valued at its bona fide selling price, basically. What you actually expect to sell it for in the near future, say within 30 days, minus the direct costs you'll incur to actually dispose of it.
Okay, you can write down damaged goods to their expected net selling price. Makes sense. Wow, that was a lot on just the building blocks.
It's the foundation. You need that before you can build the rest of the house.
Okay, now let's dive into some truly special corporate tax concepts, the things that really set C Corp apart. Let's start with the dividends received deduction, or DRD. What's the core purpose behind this deduction?
The DRD is really interesting. Its primary purpose is to mitigate what could otherwise be triple taxation of corporate earnings.
Triple taxation, how so?
Well, think about it. Corporation A earns profit and pays corporate tax on it. Then, Corporation A pays a dividend to Corporation B, which owns stock in A. Without the DRD, Corporation B might have to pay corporate tax on that dividend income.
Okay, that's tax number two.
Exactly. Then, if Corporation B eventually pays a dividend out to its individual shareholders, those shareholders pay individual income tax on that dividend.
Tax number three, on essentially the same original stream of earnings. Ouch.
Right. So the DRD is a mechanism designed to reduce or eliminate that second layer of tax, the tax at the corporate recipient level,
Yeah.
Corporation B in our example, to lessen that cascading effect.
Okay, that makes a lot of sense. So how much of a deduction does a corporation get? Does it depend on how much of the other company they own?
Precisely. The deduction percentage is tiered based on the level of ownership the investor corporation, Corp B, has in the distributing corporation.
What are the tiers?
If Corp B owns less than 20% of Corp A's stock, the DRD is 50% of the dividend received.
Okay, 50% for small stakes.
If the ownership is 20% or more, but still less than 80%, the deduction jumps up to 65% of the dividend received.
65% for significant influence.
And if the ownership is 80% or more, which usually indicates the corporations are part of the same affiliated group, the deduction is a full 100%. Complete elimination of that second layer of tax.
100% if they're basically family. Got it. Are there any strings attached, like how long they have to own the stock?
Yes, there's a minimum holding period requirement. Generally, the receiving corporation must have held the stock for more than 45 days during a specific period around the dividend date to qualify for the DRD. It prevents corporations from just buying stock right before a dividend, getting the DRD, and then selling it right after.
Makes sense. Prevents quick tax games. Now, I've heard there's a unique taxable income limitation that can sometimes reduce the DRD. How does that work?
You're right, there is a limitation, and it's a critical step in the calculation. The deduction is generally limited to the lesser of two amounts. One, the calculated DRD based on the ownership percentage, for example, 50% or 65% of the dividends received, or R2. That same percentage, 50% or 65%, applied to the corporation's taxable income.
Taxable income calculated before the DRD itself, right?
Yeah, it's taxable income computed before considering the DRD itself, and also before any net operating loss, NOL, carry-forward deduction, or any capital loss carryback deduction. It's a specific base for this limitation.
So the DRD can't exceed a certain percentage of the company's income generally. But I seem to recall hearing about a really crucial exception to this limitation. What's that about?
Ah, yes. This is indeed a key point and a very powerful exception. The taxable income limitation, that second part of the lesser of test, does not apply if taking the full calculated DRD, the 50% or 65% of dividends, would actually create or increase a net operating loss for the corporation for that year.
Wait, say that again. If taking the full deduction makes you have a loss, you get to take the full deduction anyway.
That's exactly right. The full DRD pushes the company into, or deeper into, an NOL for tax purposes. The taxable income limitation is just ignored, and they get the benefit of the full DRD.
That seems counterintuitive, but incredibly helpful for companies receiving significant dividends, but maybe having a tough operating year.
It's a fantastic rule for exactly that situation. It prevents the limitation from penalizing a company that's already hovering near or below zero taxable income.
Let's use that Duffy Corp example from the source material to illustrate this. Duffy owns 30% of Fox Corp, so the 65% DRD percentage applies. In scenario 2, let's say Duffy's taxable income before the DRD is $90,000, and the dividends they receive from Fox lead to a potential DRD of $65,000, 65% of the dividends. What's their actual DRD?
Okay, in scenario 2, the potential DRD is $65,000. Now we check the limitation. The limitation is 65% of the $90,000 taxable income before DRD. 65% of $90,000 is a $58,500.
Okay, potential DRD $65K, limitation $58, 5Ks.
Since the potential DRD, $65K, is greater than the limitation amount, $58, 5K, the DRD is limited. Duffy Corp's actual DRD deduction is the lesser amount, $58,500.
Got it. The limitation applied. Now for scenario 3, same potential DRD of $65,000, but this time Duffy's taxable income before the BRD is only $60,000. How does the exception change things here?
All right, scenario 3. Potential DRD is still $65,000. Taxable income before DRD is $60,000. Now we ask, if we took the full $65,000 DRD, would it create an NOL?
Well, $60,000 income minus a $65,000 deduction would be a negative $5,000. So yes, it creates an NOL.
Exactly. Because taking the full $65,000 DRD does create an NOL, that taxable income limitation we calculated before, $58 of 5K based on 65% of 90K in the other scenario, or 65% of 60K was 39K in this scenario, gets thrown out the window. The limitation does not apply.
So Duffy gets the full $65,000 deduction.
Yes, in scenario 3, Duffy Court takes the full $65,000 DRD, resulting in a taxable loss of $5,000 for the year. That exception is clutch.
That really highlights how powerful that exception is. Okay. Are there certain types of corporate entities that are generally not eligible to take the DRD?
Yes, the deduction isn't available to everyone. Specifically, personal service corporations, like doctors or lawyers' practices set up as core, personal holding companies, which we'll discuss later, and importantly, S corporations are not eligible for the DRD.
S-Corp makes sense. They pass income through. Any easy way to remember the ineligible ones?
The source material had a good mnemonic, don't take it personally, personal service corp, personal holding company, and S corp kind of personal in how they're taxed, too.
I like that. Don't take it personally. Okay, and when is the DRD always 100% besides that 80% ownership tier?
Well, the 80% or more ownership tier is the main one for affiliated corporations, especially if they file consolidated tax returns. The DRD is also 100% for dividends received by small business investment companies, or SBIs. These are privately owned companies licensed by the Small Business Administration to provide financing to small businesses. They get a 100% DRD on the dividends they receive from their investments.
Perfect. That wraps up the DRD nicely. Now, let's tackle a concept that I think can be a bit confusing for many people outside of accounting and tax. Why does a company's profit reported to its investors, the book income, often look so different from the profit it reports to the IRS, the taxable income?
Ah, yes, the classic book versus tax income reconciliation. It's a fundamental concept. A company's financial statements, prepared under GAAP, and its tax return, prepared under IRS rules, the Internal Revenue Code, will almost always show different bottom-line profit numbers. And the reasons fall into two main categories: temporary differences and permanent differences.
Okay, temporary versus permanent. What's the core distinction between those two?
Temporary differences are items of income or expense that are recognized in one period for book, GAAP purposes, but in a different period for tax purposes. The key word is temporary. They cause timing differences between book and tax income. But crucially, they eventually reverse out over time.
Meaning the total amount recognized for both book and tax will be the same in the long run. It's just when it's recognized that differs.
Exactly. The classic example is depreciation. A company might use straight-line depreciation for its financial statements, spreading the cost evenly, but use an accelerated method like MACRS for tax purposes, deducting more costs up front. This creates a difference each year, but over the asset's whole life, the total depreciation taken for both book and tax will be the same. It just reversed.
Okay, depreciation is a great example. Any others?
Another common one is prepaid income. We mentioned earlier that some income received in advance is taxed when received. But for book purposes, under GAAP, that income is usually recognized only when it's actually earned. So tax recognizes it earlier than book, creating a temporary difference that reverses later when the income is earned for book purposes.
Got it. So temporary differences are all about timing, not if something is recognized, just when. What about permanent differences then?
Permanent differences are items that are recognized for book purposes but are never recognized for tax, or vice versa. These differences, as the name suggests, never reverse out. The book and tax treatment will always be different for these items.
Okay, examples of things that are permanently different.
We've hit a few already. Interest income for municipal bonds is a perfect example. It's income on the company's financial statements, book income, but it's never included in taxable income.
Right, tax exempt.
Another huge one is federal income tax expense itself. It's definitely an expense shown on the company's income statement, reducing book income. But, as we said, it's never deductible for federal income tax purposes. That's a permanent difference.
Okay, federal tax expense. What else?
Fines and penalties paid to governments. They reduce book income as an expense, but they are never tax deductible. Also, that 50% of business meals that isn't deductible. That disallowed portion is a permanent difference. Life insurance premiums paid where the corporation is the beneficiary. not deductible for tax, but an expense for book. These permanent differences create a lasting gap between book and tax profit.
This is where those famous IRS schedules come in, right? Schedule M1 and Schedule M3. They force companies to lay out these differences.
Exactly. The IRS wants to see how a company got from its book income number, often the starting point, to the taxable income number reported on the tax return. Companies have to reconcile this difference on one of two schedules.
What's the difference between M1 and M3?
Schedule M1 is the simpler, older form. It basically just shows the major adjustments needed to get from book income to taxable income, but it doesn't explicitly require companies to label the adjustments as temporary or permanent.
Okay, simpler but less detailed.
Right. However, if a company has total assets of $10 million or more, it's generally required to file the much more detailed Schedule M3 instead.
And Schedule M3 gives the IRS a lot more transparency.
It certainly does. Schedule M3 requires a much more detailed breakdown of the book tax differences, and crucially, it does require companies to specifically categorize each difference as either temporary or permanent. It gives the IRS a much clearer window into why book income and taxable income are different.
To really make this concrete, let's walk through that Batson Corp example from the sources. Batson Corp reported book income pre-tax of $920,000 on its financial statements. How do we get from that $920,000 book number to their taxable income for the IRS?
Okay, we start with the book income of $920,000. Then we systematically add back expenses that were deducted for book purposes, but are not deductible for tax, and subtract income included in book income that's not taxable.
So what gets added back first?
First, we add back the permanent differences that reduce book income but don't reduce taxable income. In Batson's case, that was federal income tax expense of $80,000 and EPA fines of $50,000. Both are expenses on the books, but neither is tax deductible. So add $80K plus $50K.
Okay, $920K plus $80K plus $50K, then what?
Then we subtract permanent differences that were income on the books, but are not taxable income. Batson had municipal bond interest of $10,000. That increased book income but isn't taxed, so we subtract $10.
Okay, minus $10. Are there any temporary differences in this example?
Yes, there's one related to depreciation. For tax purposes, Batson took $200,000 of man-CRS depreciation, but for book purposes, they only took $150,000 of straight-line depreciation.
So they got a bigger deduction for tax than for book.
Right. Tax depreciation was $50,000 more than book depreciation. Since a larger deduction for tax reduces taxable income compared to book income, we need to subtract this temporary difference of $50,000 when going from book to tax.
So subtract another $50K for the extra tax depreciation. Let's run the numbers. $920,000 book income plus $80,000 federal tax accepts add back plus $50,000 EPA fines add back, $10,000 muni interest subtraction, $50,000 excess tax depreciation subtraction equals.
That brings us to a taxable income of $990,000. So even though their books show $920K profit, they actually owe tax on $990K. That reconciliation clearly shows how those seemingly small permanent and temporary differences add up, and why understanding them is absolutely essential for both compliance and just grasping a company's real tax situation.
It really does highlight the two different universes of financial accounting and tax accounting. Okay, we've laid the groundwork for income and deductions, tackled special concepts like DRD and book tax differences. Now let's move to the end game. The actual tax computations, credits, and maybe even penalties that ultimately define a C corporation's tax liability. First things first, when does a C corp actually have to file its tax return?
The main form is Form 1120, the U.S. corporate income tax return. Generally, it's due by the 15th day of the fourth month after the close of the corporation's tax year.
So for the vast majority of corporations using a calendar year ending December 31st, that means April 15th, just like individuals.
Exactly. April 15th is the big deadline for calendar year C Corp.
Yeah.
There used to be a quirky exception for corporations with fiscal years ending on June 30th. Their deadline was historically earlier, September 15th, but that changed for tax years beginning after 2015, aligning most June 30 year ends with the standard fourth-month rule, so October 15th, after a transition period ending in 2025.
Okay, so mostly the 15th day of the fourth month. And of course, if that day falls on a holiday or weekend.
Then it's automatically pushed to the next business day. Standard IRS procedure.
And what if they just need more time? Are extensions available?
Oh, absolutely. A C corporation can generally get an automatic 6-month extension to file its return by filing Form 7004 by the original due date. For those June 30 year ends, it's actually a 7-month extension.
But crucially, that's an extension to file, not an extension to pay, right?
That's a critical point. Any taxes the corporation estimates it owes are still due by the original deadline. typically April 15th, even if they get an extension to file the actual Form 1120 later.
Good reminder. Now, corporations also have to pay their taxes throughout the year via estimated tax payments, don't they? Similar to how self-employed individuals do.
That's correct. They can't just wait until they file the return to pay everything. Corporations are generally required to pay estimated taxes in 4 equal installments throughout the year.
When are those installments due?
They're due on the 15th day of the 4th, 6th, 9th, and 12th months of their tax year. So for a calendar year corporation, that's April 15th, June 15th, September 15th, and December 15th.
And if they don't pay enough on time?
If these payments aren't made timely, or they're too low, and the total tax owed on the return ends up being $500 or more, the IRS will assess an underpayment penalty.
Okay, so paying estimated taxes is important. Are the rules for how much to pay different for really large corporations compared to smaller ones?
Yes, there's a significant difference here, particularly regarding the safe harbor rules to avoid penalties. For corporations that are not classified as large corporations, they can generally avoid the penalty by paying the lesser of two amounts, either 100% of the tax shown on the current year's return or 100% of the tax shown on the prior year's return, provided the prior year showed a tax liability and was a full 12 months.
Okay, so smaller companies can often just base their payments on last year's tax. What about large corporations? How are they defined, and what's their rule?
A large corporation is defined, for this purpose, as one that had taxable income of $1 million or more in any of its 3 preceding tax years.
1 million in taxable income in any of the last 3 years makes you large.
Right. And for these large corporations, the rule is stricter. They generally must base their estimated tax payments on 100% of the tax expected to be shown on the current year's return. They don't get to use the prior year tax safe harbor, except potentially for the first installment.
So large corporations have to be much more accurate in forecasting their income and tax liability throughout the current year.
Exactly. They have less wiggle room and face a higher risk of underpayment penalties if their estimates are off.
That's a really critical difference for larger entities to manage. Okay,
Yeah.
so once they figure out their taxable income, what's the actual corporate tax rate applied to it? Is it graduated like individual rates?
Nope, much simpler now. Since the Tax Cuts and Jobs Act of 2017, a C corporation's taxable income is subject to a single flat tax rate of 21%.
21% flat. That applies to all C Corp.
Yes, whether they make a dollar of profit or billions. Personal service corporations, which sometimes had different rates in the past, also now pay that same flat 21% rate. No graduated brackets anymore for C Corp.
So on one hand, that 21% flat rate simplifies the calculation considerably. Now let's get into tax credits. These are even better than deductions, right? Because
Yeah.
they reduce the tax bill dollar for dollar.
Absolutely. Credits directly reduce the tax owed, whereas deductions only reduce the income subject to tax. So a dollar of credit is worth more than a dollar of deduction.
What's the main umbrella credit for businesses, the general business credit?
The general business credit, or GBC, isn't really one single credit. It's actually a combination, or basket, of many different individual business credits. Things like the investment credit for certain types of property, the work opportunity tax credit for hiring certain targeted groups, the research and development tax credit, the low-income housing credit, and many others all flow into this overall GBC.
So a company calculates all these different credits it qualifies for, and then they get lumped together. Is there a limit on how much GBC they can take in 1 year?
Yes, there's an overall limitation on the GBC. The total credit taken generally can't exceed the company's net income tax, which is basically the regular tax liability minus certain other non-refundable credits, minus 25% of the net regular tax liability that's above $25,000.
Whoa, okay, that's a formula. What's the logic behind that limitation?
It's essentially designed to ensure that companies, even those with significant credits, still pay at least some minimum level of tax. They can't typically use the GBC to wipe out their entire tax liability down to zero if the liability is over $25,000.
And if they generate more GBC than they can use in 1 year because of that limit?
Unused GBC isn't necessarily lost. It generally has carryover provisions. Typically, unused credits can be carried back 1 year and carried forward for 20 years, allowing companies to hopefully utilize them in other profitable periods.
Okay, carry back 1, carry forward 20. Let's zoom in on one really important component of the GBC that gets a lot of attention. The research and development, R&D, tax credit. What's the goal there and how does it work?
The R&D tax credit is a powerful incentive specifically designed to encourage companies to conduct qualified research and development activities within the United States. The idea is to reduce the after-tax cost of innovation.
How is it generally calculated?
The calculation can be complex, with a couple of different methods available, but the most common regular credit method is generally based on 20% of the increase in the company's qualified research expenditures, QREs, over a calculated base amount, which reflects historical spending.
So it rewards increases in R&D spending. Is there a special benefit for smaller businesses with the R&D credit?
Yes, this is a fantastic feature. There's a provision specifically for qualified small businesses. These are generally defined as companies with less than $5 million in annual gross receipts, and importantly, that have had gross receipts for no more than 5 years. Startups, basically.
Okay, what do these qualified small businesses get?
They can elect to use a portion of their R&D credit up to $250,000 per year to offset the employer's share of FICA payroll taxes, Social Security tax, rather than using it against income tax liability.
Wow. So even if a startup isn't profitable yet and doesn't owe income tax, that they can still get a direct cash benefit from the R&D credit by reducing the payroll taxes they have to remit.
Exactly. It's a huge boost for early-stage, innovative companies that might be burning cash but are investing heavily in R&D and have employees. It makes the credit immediately valuable even without income tax liability.
That is a great benefit. Okay, shifting gears now to corporations operating globally. The foreign tax credit, FTC, must be incredibly important for them. What's its main purpose?
The FTC is absolutely critical for multinational corporations. Its main purpose, similar to the DRD's goal, is to prevent or mitigate double taxation. In this case, it's about double taxation of income earned by a U.S. corporation from foreign sources.
How does that double tax happen?
Well, a U.S. company might earn profits in, say, Germany. Germany will likely tax those profits according to German tax law. Then, because U.S. corporations are generally taxed on their worldwide income, that same income could potentially be taxed again by the U.S. The FTC is designed to provide relief from that second layer of U.S. tax on foreign earnings.
So it keeps the total tax rate from getting excessively high just because the income crossed a border. Do companies have a choice in how they get this relief?
Yes, corporations generally have an annual choice. They can choose to either take a credit for the eligible foreign income taxes they've paid or accrued, or they can choose to take a deduction for those foreign taxes.
Credit versus deduction. Which do most companies choose?
Overwhelmingly, they choose the credit. As we said before, a credit provides a dollar-for-dollar reduction of U.S. tax liability, whereas a deduction only reduces taxable income by the tax rate, 21%. So the credit is almost always more valuable.
Makes sense. How is the foreign tax credit actually calculated? It sounds like it could get a bit complicated, especially with income from multiple countries.
It definitely can get complicated, especially with different categories or baskets of foreign income. But the basic framework involves 3 main steps.
Okay, step 1.
Step 1 is to determine the amount of qualified foreign income taxes paid or accrued during the year. These have to genuinely be income taxes in the U.S. sense. Things like foreign property taxes or sales taxes generally don't qualify for the credit. And the tax must relate to income earned within that foreign jurisdiction.
Okay, identify the qualified foreign income taxes. Step 2.
Step 2 is to compute the foreign tax credit limitation. This is crucial. The limitation prevents a company from using foreign taxes paid on foreign income to offset U.S. tax on its U.S. source income.
How is the limitation calculated?
The overall limitation is calculated by taking the company's total pre-credit U.S. tax liability on worldwide income and multiplying it by a ratio, the company's foreign source taxable income divided by its total worldwide taxable income.
So U.S. tax, foreign income, worldwide income. That fraction represents the proportion of your total income that came from foreign sources.
Exactly. You can only offset the U.S. tax attributable to that foreign proportion.
Okay, that makes sense. So step 1 is the tax paid. Step 2 is the limitation. What's step 3?
Step 3 is simple. The actual foreign tax credit you can take for the year is the lesser of the qualified foreign taxes paid or accrued from step 1 or the calculated FTC limitation from step 2.
Lesser of tax paid or the limitation. Got it. Let's use that Roco example again. They had $20 million in worldwide taxable income, $5 million of which was from foreign sources. They paid $2.5 million in qualified foreign taxes, and the U.S. tax rate is 21%. What's their FTC?
Okay, let's follow the steps. Step 1. Qualified foreign taxes paid are $2.5 million. Step 2. Compute the limitation. First, the pre-credit U.S. tax is $20 million times 21%, which equals $4.2 million.
Okay, $4.2 million U.S. tax.
Now, the limitation ratio. Foreign source income, $5 million, divided by worldwide income, $20 million, equals 0.25 or 25%.
Right, 25% of their income was foreign.
So the FTC limitation is the U.S. tax, $4.2 million, times that ratio, 25%, which equals $1,050,000.
Okay, limitation is $1.05 million.
Step 3. Compare the tax paid, $2.5 million, to the limitation, $1.05 million. The credit is the lesser of the two.
So Roko's foreign tax credit is limited to $1,050,000.
Correct. Even though they paid $2.5 million in foreign taxes, they can only use $1,050,000 as a credit against their U.S. tax in the current year due to the limitation.
What happens to the extra $1.45 million in foreign taxes they paid but couldn't credit? Is that just lost?
No, thankfully not. Excess foreign tax credits, the amount paid above a limitation, can generally be carried back 1 year and carried forward for 10 years to offset U.S. tax on foreign source income in those other years.
Carry back 1, carry forward 10 for excess FTCs. Good to know. Okay, that breaks down a complex area really well. Finally, in this segment on computations and credits, let's touch on something corporations definitely want to avoid: penalty taxes. These are taxes on top of the regular corporate income tax. What's the accumulated earnings tax?
The accumulated earnings tax, or AET, is a penalty tax. It's imposed on regular C corporations, not S Corp or PHCs we'll discuss next, that improperly accumulate earnings, meaning they hold on to profits, instead of distributing them to shareholders as dividends.
Why would the IRS penalize a company for saving money?
The concern is tax avoidance at the shareholder level. If a corporation just keeps piling up cash indefinitely without a good business reason, the IRS might suspect it's doing so primarily to help its shareholders avoid paying individual income tax or the lower dividend tax that would be due if dividends were paid out.
So it's about unreasonable accumulation. Is there a threshold?
Yes, corporations are generally allowed to accumulate up to $250,000 without having to justify it. For certain personal service corporations, like doctors, lawyers, accountants, that safe harbor amount is lower, only $150,000. Earnings accumulated above those amounts are potentially subject to the AET if they're deemed unreasonable.
And what's the penalty rate?
It's a flat 20% tax imposed on the accumulated taxable income for the year, which is basically the improperly retained earnings. And importantly, this tax is assessed by the IRS, typically during an audit. It's not something the corporation calculates and pays on its own return initially.
Okay, so it's an IRS-imposed penalty if they find unreasonable accumulation during an audit. How can a corporation defend itself or avoid this tax?
The key is to demonstrate that the accumulated earnings are being retained for the reasonable needs of the business. This requires having a specific, definite, and feasible plan for the use of those funds.
Like what kind of plans?
Could be plans for business expansion, acquiring property or equipment, funding R&D, paying off debt, having working capital reserves, or even funds needed to redeem the stock of a deceased stockholder. Having clear documentation of these plans is crucial.
So good planning and documentation are key. Can paying dividends help?
Absolutely. Paying out actual dividends reduces the amount of earnings accumulated. There's also something called consent dividends, where shareholders agree to be taxed on a certain amount as if it were distributed, even if no cash changes hands. Both actual and consent dividends, paid by the return due date, including extensions, can reduce or eliminate exposure to the AET.
Okay, that's the AET, focused on unreasonable general accumulation. What about the personal holding company tax? You mentioned it briefly. Is that similar?
It's another penalty tax, also at a 20% rate, but it targets a different kind of perceived abuse. The personal holding company, PHE tax, is aimed specifically at corporations, often closely held, that are primarily used to hold passive investments and generate income like dividends, interest, and royalties, rather than running an active trade or business.
So it's trying to start people from setting up a corporation just to hold their stock portfolio at the lower corporate tax rate.
Exactly. It prevents high tax bracket individuals from incorporating their investments just to shelter that passive income at the 21% corporate rate instead of paying potentially higher individual rate.
How does the IRS define a personal holding company that's subject to this tax?
There are two main tests, and both must be met. First, an ownership test. More than 50% of the corporation's stock must be owned directly or indirectly by 5 or fewer individuals at some point during the last half of the tax year.
Okay, closely held. What's the second test?
Second is an income test. At least 60% of the corporation's adjusted ordinary gross income must consist of certain types of passive income, known as personal holding company income. This includes things like taxable interest, most royalties, dividends from unrelated corporations, and sometimes rent, unless rent makes up a very large portion of income and other tests are met.
So closely held and mostly passive investment income. If a corporation meets both tests, what happens?
If it's deemed a PHC, it faces that additional 20% penalty tax, but this time it's applied to its undistributed personal holding company income.
Undistributed. So similar to the AET, paying out dividends can avoid this tax too.
Yes. If the PHC distributes its net income via actual or consent dividends, there's no undistributed income left to be taxed by the PHC penalty tax.
Is a PHC also subject to the accumulated earnings tax?
No, that's a key distinction. If a corporation is classified as a PHC, it is not subject to the accumulated earnings tax.
Yep.
The PHC tax regime applies instead. Also, unlike the AET, which is IRS assessed, the PHC tax is self-assessed by the corporation. They have to determine if they meet the tests, and if so, file Schedule PH, Form 1120, and pay the tax.
Okay, so two distinct penalty taxes, AET for general unreasonable accumulation in active businesses, and PHC tax for incorporated passive investment portfolios, both trying to prevent corporations from being used solely for tax avoidance. It's clear the IRS has tools to discourage that. Now let's move to our final segment, which is all about navigating downturns, calculating loss limitations for C corporations. Let's start with the big one, net operating losses, or NOLs. What exactly is an NOL?
Simply put, an NOL occurs when a corporation's allowable tax deductions for a year exceed its gross income for that same year, resulting in a negative taxable income or a loss for tax purposes.
Okay, deductions are more than income. How can companies use these NOLs? Can they use them to offset income in other years?
Yes, that's the main benefit of an NOL. They can be used to offset taxable income in other years, reducing taxes in those profitable years. However, the rules for how they can be used, specifically whether they can be carried back to prior years or only forward to future years, and how much income they can offset have changed significantly and depend heavily on when the NOL was generated.
Ah, this is where those specific dates become really critical again, right? Can you walk us through the current carryback and carry forward rules? This seems really important.
It is very important, and the changes were quite dramatic. Let's focus on the rules applicable now. For NOLs arising in tax years beginning after December 31st, 2020, so basically NOLs generated in 2021 and later,
Okay, recent losses.
those NOLs cannot be carried back to prior tax years at all. Zero carryback allowed.
Wow, no carryback for recent losses. That's a huge shift from historical rules.
Huge shift. Instead, these post-2020 NOLs can only be carried forward. But the good news is they can be carried forward indefinitely until they are fully utilized.
Okay, no carryback, but indefinite carry forward for NRLs from 2021 onwards. What about NLs from just before that, say 2018, 2019, 2020? Weren't there temporary rules due to COVID relief?
Yes, you're right. The CARES Act introduced a temporary, more generous rule for NOLs arising in tax years beginning in 2018, 2019, or 2020. Those specific NOLs could be carried back 5 years, providing quick refunds for companies hit hard during that period. They could also be carried forward indefinitely, but that was a temporary window.
Got it. So the 5-year carryback was temporary relief. The default rule now for new NOLs is no carryback, only indefinite carry forward. Is there an option to waive a carryback even when it was allowed?
Yes. Even during the periods when carrybacks were allowed, like under the CARES Act or pre-2018 rules, taxpayers could make an irrevocable election to forego the carryback period and only carry the NOL forward. Sometimes that makes strategic sense if prior year tax rates were lower, for instance.
Okay, complex history, but the current rule for new NRL is clear. No carryback, forward indefinitely. Now, there's also that 80% limitation we heard about. How does that fit into the NOL picture?
Right, the 80% limitation. This is another major change affecting the use of NOLs, specifically those generated in post-2017 tax years when carried forward.
How does it work?
Okay, so NOL carryforwards generated in tax years before 2018 can still offset 100% of taxable income in a future year until they're used up. But for NOL generated in tax years beginning after December 31st, 2017, 2018 and onwards, when they're carried forward to tax years beginning after December 31st, 2020, i.e. to 2021 and later years.
Okay, post-2017 losses being used in 2021 or later.
Those NOLs can only offset up to 80% of the taxable income in that carry forward year. Taxable income here is calculated before the NOL deduction itself.
So even if a company has a massive NOL carry forward from, say, 2021, when they try to use it in 2023, they can only use it to wipe out 80% of their 2023 taxable income. They still have to pay tax on the remaining 20%.
That's exactly right. It ensures that companies with large NOL still contribute some tax in profitable years, rather than potentially zeroing out their liability completely for many years. This 80% limitation applies after any older pre-2018 NOLs, which can offset 100%, have been utilized first.
That's a really significant change, limiting the immediate benefit of those NOLs. Let's use that Reichel Core example again to see this 80% limit in action. Reichel had a $100,000 NOL generated in 2021. In 2022, their taxable income before considering the NOL was $90,000. How much of that 2021 NOL can they actually use in 2022?
Okay, the NOL is from 2021 post-2017, and it's being used in 2022 post-2020. So the 80% limitation applies. Reichel calculates 80% of its 2022 taxable income before the NOL. 80% of $90,000 equals $72,000.
So even though they have a $100K NOL available, they can only use $72,000 of it in 2022.
Correct. The NOL deduction is limited to $72,000. Their taxable income after the NOL deduction in 2022 is $90,000 minus $72,000, which equals $18,000. They still have tax to pay on that $18K.
And how much of their NOL is left to carry forward?
They started with $100,000 and used $72,000. So $100,000 minus $72,000 leaves $28,000 of NOL remaining to carry forward to 2023 and beyond.
Okay. Now, what if in 2023 their taxable income before the NOL is $50,000? How much of that remaining $28,000 NOL can they use?
Good scenario. They have $28,000 of NOL carry forward left. We again apply the 80% limitation based on 2023's income. 80% of $50,000 is $40,000.
So, okay, the limit is $40,000.
Now, the NOL available, $28,000, is less than 80% limitation amount. $40,000, they can use the entire remaining $28,000 NOL.
Ah, so the 80% is a ceiling, not a floor. If your NOL is less than 80% of income, you can use it all.
Exactly. So in 2023, Reichel uses the full $28,000 NOL. Their taxable income after the NOL is $50,000 minus $28,000, which equals $22,000. And now their NOL carry forward is fully used up.
That really illustrates how the limitation works year by year and interacts with the amount of NOL available. Very clear. Are there any other sort of special points or adjustments to keep in mind when calculating the corporate NOL itself?
Yes, there are a few specific rules for the calculation of the NOL in the loss year. For instance, the charitable contribution deduction is not allowed when calculating an NOL. Why? Because that deduction is limited based on taxable income, and if you're calculating an NOL, you don't have positive taxable income to base it on.
Okay, no charitable deduction in the NOL calculation itself. What else?
Remember that DRD exception. The normal taxable income limitation on the dividends received deduction does not apply if taking the full DRD actually creates or increases the NOL. So the full DRD can contribute to making the NOL bigger.
Right. The NOL exception for DRD helps here.
Also, an NOL deduction carried from a prior year is not allowed when determining the current year's NOL. You can't use an old OL to make a new NOL bigger. You're just looking at the current year's income and deductions.
Makes sense. Prevents compounding losses in a way. Anything involving capital losses.
Yes. A corporation can deduct a capital loss carryover from a prior year against a capital gain in the current year when calculating the current year's NOL. However, a capital loss carryback from a future year cannot be used to increase a current year's NOL.
Okay, carryover's okay in the calculation, carryback's not. That last point leads us nicely back to capital losses for corporations. We've hit the main points, but let's just quickly recap their unique treatment, especially in this context of overall losses.
Absolutely. It bears repeating because it's so different from individuals. The absolute key takeaway. C corporations do not get that $3,000 deduction for net capital losses against ordinary income. Not allowed. Ever.
So if a corporation has, say, $50,000 in capital gains and $80,000 in capital losses in a year, what's the result?
They have a net capital loss of $30,000. They can use the $50,000 of losses to fully offset the $50,000 of gains, bringing the net capital gain loss to zero for the current year's income calculation. But that remaining $30,000 net capital loss, it cannot be used to reduce their ordinary business income from operations.
It just sits there. What happens to that $30,000 net capital loss?
It becomes a capital loss carryover. The rules are net capital losses are carried back 3 years and then forward 5 years.
Back 3, forward 5. Is it treated differently when carried over?
It's carried over and treated as a short-term capital loss, regardless of whether the original loss was short-term or long-term. And again, even in those carry-back or carry-forward years, it can only be used to offset capital gains. If the corporation doesn't have enough capital gains in that 3-year back, 5-year forward window to absorb the loss, it expires unused.
Expires worthless after 5 years forward of no gains. Ouch. Okay, let's use that final Lane Core example to see how a capital loss carryover can affect the NOL calculation, tying these concepts together. Lane Core has gross income of $400,000, and that includes a $150,000 capital gain. They have $500,000 in operating expenses, and they also have an unexpired capital loss carryover of $20,000 from a prior year. How does this all fit together to find their NOL?
Okay, good example tying things together. First, Lanecore uses its $20,000 capital loss carryover to offset part of its $150,000 current year capital gain.
So 150K gain minus 20K loss carryover leaves a net capital gain of 130K.
Correct. Their net capital gain included in gross income is now $130,000. This means their adjusted gross income for the NOL calculation is effectively the original $400,000 minus the $20,000 capital loss carryover that was used, bringing adjusted gross income down to $380,000.
So using the capital loss carryover reduced the income component of the NOL calculation.
Exactly. Now we calculate the NOL. $380,000 in adjusted gross income minus the $500,000 in operating expenses.
380K minus $500 is a negative $120,000.
Right. So Lanecorp has a net operating loss of $120,000 for the current year. The capital loss carryover, by offsetting some capital gain, effectively increased the size of the current year NOL compared to what it would have been without the carryover.
That's a really complex interplay, but walking through it makes it so much clearer how these different loss rules interact and affect the ultimate bottom line for tax purposes.
It really is a puzzle, putting all those pieces, NOLs, capital losses, carryovers, limitations together correctly.
And that, believe it or not, wraps up our deep dive into the surprisingly intricate world of C corporation taxation. Wow, we covered a ton of ground today.
We really did. From the very basics, the nuances of what counts as gross income, and the crucial, ordinary, and necessary standard for deductions,
To navigating those special corporate concepts like the dividends received deduction, understanding why book income and tax income are almost never the same.
we also explored how corporations use tax credits, like the R&D credit and foreign tax credit, to strategically cut their tax bills, and maybe just as important, those penalty taxes, AET and PHC, that the IRS uses to discourage certain behaviors.
And finally, we just broke down those really critical and recently changed rules around net operating losses and the unique treatment of capital losses for C corporations, showing how they handle downturns and how those losses impact future taxes.
Yeah, the loss rules, especially with the carryback changes and that 80% limit, are key takeaways.
We really hope that after this deep dive, you, our listener, have a much clearer, more nuanced understanding of how C corporations are taxed way beyond just that surface level income minus expenses idea we started with. You've hopefully uncovered some of the specific rules and strategic implications that really make all the difference in corporate finance.
And maybe, just maybe, it was a little less painful than reading the tax code itself. For our final thought today, consider this. We've talked about a lot of specific rules for C corporations, the flat 21% tax rate, the details of deductions like interest limits, the very strict rules around using capital losses, the 80% NOL limitation, even those potential penalty taxes for holding on to earnings. How do you think these specific tax characteristics taken together actually influence the big strategic decisions made by large corporations?
Like how they decide to finance their operations debt versus equity, or how they manage their profits and decide whether to reinvest or distribute them, or even where they choose to earn income globally.
Exactly. How do these purely tax-driven rules shape real-world business behavior? And then maybe take it one step further. What might that imply for your understanding of the broader economy, the flow of capital, and the underlying incentives that are constantly at play?
That is powerful stuff to chew on. Definitely gives you a new lens through which to view business news and corporate actions. We really encourage you to keep asking those kinds of questions, keep being curious, and keep diving deeper into the fascinating world of finance.
Absolutely. Never stop learning.
Thank you so much for joining us on this deep dive today. We hope you found it valuable, and we invite you back for our next exploration.